Did you know that a survey showed that 57% of millennials have a strong enough desire to be a homeowner and to be willing to purchase a home that smelled like cigarette smoke? 57% of millennials would buy a home that smelled like cigarette smoke because their strong desire to be a homeowner. 41% said they would purchase a home that had asbestos in it. Asbestos, guys, which is not good stuff. Google that. That was used in home building like before the 1970s, 80s, and 60s and 50s and all before. 41% said they'd be willing to buy a house with pests in it, such as mice, cockroaches, or spiders. And 40% said they would buy a house with a leaky roof. 40%. 35% said they'd be willing to accept foundation issues as well. So maybe the house would fall down. I don't know, but they're willing to take the risk because they just want to get in the game. Guys, my name's Kelly Cook. We are on Everything Phoenix. We run this YouTube channel for years now. We are live. And thank you for joining us here today. This is not our normal time that we come live, but we decided, because yesterday was a holiday, the President's Day, we decided to not skip it and rock and roll with the YouTube live on a Tuesday and see what happens. What's the worst that could happen? But hopefully you guys get value out of today, and then we'll rock and roll and get back on our normal time of Monday at lunchtime, 12:30 local time, guys. So that was a survey that came straight from a couple different resources that millennials want to be homeowners, but they feel that the price range could be a little out of reach. So is there a crack in demand? Is there a crack with mortgage rates coming down, but are they on the rise too with demand? And can demand really be on the rise if rates are not going down? Well, we're going to jump in that here today and talk about everything with real estate here in the Phoenix, Arizona area. All right, so here we go. All right, Rick, what's going on? Alvarita not cutting prices. There's not a lot of cutting prices going on, which is crazy, right? Rick, thank you for jumping in here, guys. By the way, if you are watching somewhere, go ahead and put in there if you don't mind, like where you're watching from. I wouldn't mind just knowing that. The algorithm would love to know that. It helps curate the content a little better. And let's have a two-way conversation. Thanks for commenting, Rick, and let's go rock and roll with that. If you're watching the replay, leave a comment below and let's get after it. Okay, I'm going to share my screen here. And we're going to start really quick here because I think it's important to know where we stand overall in Phoenix in terms of a buyer's market. All right, so here we go, baby. Speaking of baby, yeah, Rick, I see you. Vegas, baby. Vegas, baby. That's what we always said. I still say that. I'm glad you say it too. Vegas is awesome. Obviously, about a 55-minute flight from Phoenix, so it's easy to get there and get back. Love going to Vegas as well. So thanks for tuning in here, Rick, because there's a lot of similarities between Phoenix and Vegas here. So let's see what we got going on. I promise I will not waste your time. I promise I'll give you some good information here, and then we'll get out of here and let you get back to your day. So thanks for tuning in. And tuning in at the very end, we'll cover some things when it comes to tactical aspects of potentially purchasing a home here today. All right. So overall, guys, 85.5, that is not good. Well, it depends what side you're looking at. See, I heard this a long time ago that nobody wants to buy a home when the market's declining. Nobody likes a declining market. Okay. Now, obviously, you don't want to buy a home potentially because where's the falling knife going to be caught? Where's it going to fall? Where's it going to stop? But the reality is everyone likes to purchase real estate in an increasing market. Yes, even buyers. Why? Because they feel good about when they purchase, things will hopefully keep running. But in a not so great market, in a buyer's market where values may be declining, or at least demand is declining, nobody likes that because sellers are like, well, that sucks for us. And buyers are like, well, it could go down longer, could go down more. So I'm going to sit here and wait. And the reality is you don't know you're in a bottom of a market until you're out. So take advantage with what you know at the current time. That's the point, right? And you can see right here that we're at 85.5. A balanced market in Phoenix is 90 through 110. And so we are in a buyer's market. Congratulations if you're looking to buy. And guys, you can see our screen right here that these are the suburbs, okay? The top 17 suburbs in the Phoenix area. And you can see there's a lot of red on the board, which coincides perfectly with this 85.5. But if you're looking for a certain area of town, there you go. Now, obviously, if you look at numbers 1 through, what do we got here, 7, they're still in a seller's market, even though they are declining change week over week, month over month here, right? But you do have two that are going up, 13 and 14, Goodyear and Queen Creek. They're still heavily in a buyer's market, guys. So again, congratulations. You got to look at both sides of this, right? You can't really have your cake and eat it too in most cases. Sometimes you can. I understand that. But in most cases, you cannot. All right, so let's talk about this a little bit longer here, and then we'll jump into some cool stuff here regarding the overall economy and some local stuff here in Phoenix with development. All right, sales per month. Okay, we won't geek out too much on this, but you can see right here, look at this red line. This is 2025. It's drop, 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 drop. Uh-oh, we have an uptick. Could that mean demand is starting to turn the corner? And as you can see, guys, every single year, including 2020, right, we had an uptick of demand about this time. So this would not be a surprise. Now, if we have an uptick of demand, does that mean that the buyer's market will probably keep continuing and that 85.5 right here will continue to go down to 82, 80, 79, and so on and so forth? Probably not. If you will go off of what the trend currently is and historical data. All right, Rick, what's going on here? Thanks for the comment here again. Future value better in Queen Creek or Alvarita? Thanks. Well, I'm going to say Queen Creek in this one. I really am. I don't think it's, I mean, it could be close, but I think Queen Creek is your better play there. There's a lot going on in Queen Creek. And if I pull up my map right here, let's check this out here, because down here you got Queen Creek, right? There's Queen Creek. And then you have Santan Valley, and then you start getting unattached land right about through here, where you're going to drive a little bit through farmland, desert, etc., down to Florence, okay? But Queen Creek, because it's attached, there's so much going on. And then you take in the fact that you have Coolidge, Florence, all this area down here, right? Casa Grande, even Maricopa, this little, I call it the smile, right? From Florence, Coolidge, Casa Grande, and Maricopa, the smile of Pinal County. That there is a ton on the docket for development because why? Land is cheap. So you have a lot of jobs. Kohler is building a huge plant down there. You know, the faucets and bathroom manufacturer, right? They're building a huge plant. You have Lucid Motors down there. You have LG building a big battery plant, obviously in Queen Creek on the outskirts there, and so on and so forth. The list goes on and on. So I think that Queen Creek would be the better play to answer that question. All right, Rick, back to the thing. But if you have more questions, fire away, please. Sales per month, you see the trend right here in the red. We're talking about that. And then does the pending listings corroborate that? And it does, guys. Check this out. Boom, 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 boom. So pending listings are, I mean, skyrocketing in terms of where they were around the New Year's or Christmas time of end of 2024. And so it does every year, guys. So you look at this action that we should have historically and we are having this year. And you would go back to here and say, you know what? I don't think this 85 is going to continue on a downward trend. I just don't see it. The one thing that could stop that or be the counter argument to that is the active listings right here. Okay. Why? Because look at, they're increasing. And if they continue to increase at this pace, we could be some trouble. Guys, for perspective, let's pop in 2009. Okay. All right. Even then it didn't like skyrocket, but it's already really high. Let's go 2008. You're going to see some change 2007. Okay. You start seeing it now. Let's take off 09 and 08 because we were already in the dumps at that point. Let's go 06. See the increased amount of active listings, and it kept going all the way into pretty much end of the year towards October, November. So if you got something like this, then okay, I could buy the fact that this number here at 85 will continue to decrease into a further buyer's market. However, guys, what on the economic horizon is out there that would suggest that 2025 is going to be similar to 2006 and 7 when we had literally the worst economic meltdown since the Great Depression? There isn't. Now, there's some not so great things. I get that. But we're talking, guys, a 70% decrease in home values in the Phoenix area back in those years. I know because I was selling real estate. I got in the business in 05, and it was a bloodbath, okay, for a little while there. So I don't think we have perspective like that. Now, that's going to keep this increased because a lot of these guys right here and here in 06 and 7 were foreclosures, short sales. People have no equity, guys. And right now in America, homeowners, the majority have equity. Okay. So I don't think it's going to probably be the case. So that being said, this right here, this demand and this demand for the sales that were lagging, that now, because the pending sales are closing escrow, it's ramping up here. We'll probably do something like this through the season, through June even, okay? So I don't know that you're gonna see this, guys, continue to go down this 85. And therefore, if it doesn't, the leverage on a negotiation of a real estate transaction will start to turn the corner, okay? But right now, you got a lot of leverage, guys. In fact, let's just stay on this and let's jump right to it because I'm feeling good right now. Let's jump right to it. Here we go. Let's get tactical. Here's an amortization calculator right now, Credit Karma. It's a good one. There's a lot of them out there. If you were to buy a home for $500,000 here, anywhere in America, this goes anywhere, but let's talk Phoenix, right? Because the median home value in Phoenix is actually under $500,000. It's hovering around like about 460 right now, okay? Plus or minus, right in that area. 460 median home sale in Phoenix, Arizona. So if you buy a home for 500, you're going to put 10% down. Now you can manipulate these numbers. You can do 5% down, 20% down, your choice. But let's say you're going to put 10% down. That is $50,000 out of your pocket. You're going to put down at closing, leaving you with a loan from a lender for $450,000. Now, if you did your typical 30-year fixed mortgage, which right now is at a rate right here, boys and girls, ladies and gentlemen, 7.02 as of today, 7.02 as of today, then you're looking at 7%, 30 years, and that's your payment P&I, principal and interest only. Now you do have property taxes and insurance and possibly HOA to consider on top of that. But this is perspective. We're going to keep apples to apples. Here you go. Your payment is $29.93 a month at 7%. But what if, okay? Now, what if you wanted to actually negotiate this out and do something different with negotiations, guys? Here's what I told the client the other day, and it's so true. This is very true. If a home was listed at $500,000, we're going to try to get the lowest possible price for you on your behalf, guys. Okay. Now, but let's say it's not been on the market for 6 months or anything crazy like that. Is the seller going to go and say, you know what, I want to have, I'll go ahead and give it to you for 470 or 480? Probably not. Probably not. Now, will they negotiate in good faith, knowing that there's other supply on the market and they just want to get out of the house or whatever? Sure. Let's say we can get 490 on that number. Now, there's a chance in this scenario that, let's say in this example, just hypothetically, we get 490 on the price, but we get a $20,000 potentially credit that we can use for a rate buy down. Now, in the purchase contract, the purchase price is still going to remain 490. So it looks better optics to the seller, like, oh, I'm getting 490. But the reality is, if you're giving us a $20,000 credit to get a 3, 2, 1 rate buy down, you know where I'm going with this, guys, a rate buy down, okay? Then they're netting 470 plus their fees, okay? 470, not 490, but the purchase contract says that the purchase price is 490 because it is. But we are having them pay for our rate buy down for 2 to 3 years, okay? Now, let's go back to this example. If we do that, we buy the same home, $500,000, and we get a 3-2-1 rate buy down, that means in year one, 3 points off, our interest rate for year one is going to be 4%. That gives us, right here, guys, a difference in payment of $2,148.37. Guys, that is a difference of $845 a month. A month that you are saving on your payment. You take that times 12, and that is a total for the year of $10,145. Real money in your pocket. But Kelly, that's not permanent. You're right, it's not. Year two, okay? I got it teed up for you. Year two, it does and will adjust to 5%. From 4% in year one, 5% in year two, and now your payment jumps up to $2,415. But still, look at the difference. You're still saving about $550, okay? A little more actually, per month on your payment for year two. Pretty sweet, right? Okay. Well, then it's going to adjust again. You're right. It will. In year three, it goes to 6%. You see right here. But that jumps your payment to $26.97, which is still about $300 cheaper than what it would be without a rate buy down. Okay. So 300 times 12, that's easy math in my head. That's $3,600 that you would save over the course of the year. So you total all that up, and you're looking at the cost of this and savings to be around that same $20,000 plus or minus that the seller gave you. You just didn't get the check or didn't see the purchase price being reduced on the negotiations of the deal. Now, why would you do this? You would do this because okay, this is the important part. You're going to assume that the interest rate on a 30-year fix, in this example, will be less than rates will come down than they are today. That's what you would make that quote unquote gamble. But guys, it wouldn't be a gamble. And here's why. Two reasons. Number one, you are already comfortable with the payment of the fully indexed rate of 7%. Share my screen again. 7%. This payment right here, $29.93. Okay. You are comfortable with that. You may not want to pay it, maybe a little bit of a stretch, but you can do it. If that is the case, then you're good, right? Because hopefully, even if the worst case scenario happens and rates don't go down or they go up or they stay the same, whatever, you will still be able to pay that number, even though you really don't want to. Now, the problem people get into is they go, well, I can't really afford that, but I mean, I could on paper, I can, but I can't really afford it in real life. And so, but rates will definitely come down. They may not. They should, and they most likely will, but they may not. It's not a guarantee in life. We clearly can understand that. Okay. So I appreciate the, Rick, thank you very much. Good explanation of savings over 3 years. Thank you very much. I appreciate that. And here's the good news, Rick, and everybody else listening, that in the event in 3 years, rates do come down. Maybe they come down to a flat 6%. So you like, hey, that's pretty good. I'm not sure if they're going to keep going down much lower than that. That's based upon, who I'm listening to, where I'm getting my information from, the research I've done. And at that time, it's 18 months into it. And you say, you know what, I'm going to go ahead and refinance into that 6% permanent loan. Okay, cool. Well, when you do, you have to get the credit of the year and a half you haven't used yet on that 3 year to use towards any costs you may have on the refinance. So hopefully it's a net wash. Maybe you even have a additional credit you can use for a rate, some sort of discount point on that refinance. I know I'm going to the weeds on this a little bit, but the point is you won't lose that money if you choose to refinance prior to using all 3 years of the rate buy down in that example. Hopefully that's clear. And guys, the second reason I said there's 2 reasons. The second reason is because of this right here. 85.5. That is a buyer's market. And when you're in a buyer's market, you have more leverage on negotiations. Okay. This may turn around. We can see that the charts, pending and sales, are going in this direction now. They're going up. When they go up, this number overall, in terms of the supply demand buyer's market, right, will start to strengthen and go back the other direction. Does that mean you won't have any leverage? No, of course not. It depends where you're buying. There's all kinds of reasons as to why you may or may not. Niche real estate is niche in terms of location specific, right? So, but overall, generally speaking, you have good negotiation leverage right now. And if you want to get that rate buy down, something that's probably pretty smart to do. Okay, now here's the rates. We talked about that, 7.02 currently today. And here's the article about the millennials. It's pretty fascinating, right? And that is real estate agents' commissions have shifted since an AR settlement. Well, that's a whole other conversation. Maybe I'll do a video on that because we could talk another 30 minutes about that one. And I don't want to bore you to death. But the point is that demand is there. They're waiting on the sidelines. And I think this right here article in the Phoenix Business Journal sums it up. If mortgage rates go from 7 to just 6.5%, not 6.5%, that could unleash all kinds of buyers onto the market, Fairweather said. But that's really up in the air right now. Why? Because it is. And by the way, this is an economist from the Redfin area, Redfin Group, right? Company. Okay. It is up in the air. And let's go to a couple articles about that. Okay. What's propping up inflation? Blame housing. Okay. Housing is propping up inflation. So inflation doesn't move. If it does not move, then you still have higher rates for the somewhat near term, right? But it talks about how home prices are going up. Now, this is nothing new, but what I want to show you guys on this is what makes up inflation. Now, we talked about this with the PCE index. There are 2 indexes, that and CPI. But this also mentions how the CPI gets their information and comes to their conclusions. And so we're not going to stick on it very long, but here we go. Okay. Housing is where most of the remaining gap is when it comes to inflation, according to the Fed. All right. But what's crazy is the two primary subsets of the results of the CPI. The conclusion of it is the rent of primary residences, rent, not home sales, and number 2, owners' equivalent rent of residences. Again, we talked about this in a couple of YouTube lives and a couple of videos ago. This is crazy. This measures how much it would cost homeowners to rent the house they live in. So it is what someone could get for rent and what residences are actually renting for. Now, do you see that there could be a flaw in that? First of all, it's a lag measure because they only go out and get these things, these data points once every 6 years, once every 6 months, okay? Because there are 6 different sections across the year that they are looking at. This is pretty wild, okay? So some of the inflation we're experiencing in rent is actually happening or happened 12 to 18 months ago because of the lag. And it's only now filtering through the official series, okay? So what they're basically saying at the end of the day here is that the impact of rising home prices has been felt across most of the country, of course, and that we will wait to see what happens, but that they anticipate the CPI coming down in the inflation mark, which if they do, guys, pay attention. If they do, rates should be able to start to soften a little bit and come down when it comes to mortgage rates, okay? So we're all looking towards that. All right. Now I'm going to jump in here and do a couple little things here when it comes to development and what's going on around Phoenix, because guys, these are things that are happening every single day. These articles are coming out from the Phoenix Business Journal, which source some really good stuff. And the Phoenix is named once again a top 10 market for commercial real estate investment. Why is that important? Because if the smart money, the big money, the private equity is pouring into investments like this LG battery plant right here, and of course the companies that follow, that means you're going to have some employment that's going to be really good in the Phoenix area in the future. And Valley ranked number 10 overall, a drop from the 7th spot last year. But number 10, top 10, you're doing something well. They anticipate Phoenix being good in the near future. But and speaking of commercial development, Buckeyes leaders see Core Power site as a prime opportunity. Now, Core Power was going to build a battery plant right here in Buckeye, guys. Here's the map. Buckeye is huge. It is this area on the south of the I-10 right here, as well as west of the White Tank Mountains, which are that shaded area right here. Okay, so Buckeye is this whole huge area, a ton of open land. Well, Core Power decided to not proceed with the battery plant because they had some issues internally. They didn't get the funding from the government they wanted, at least the amount they wanted, and they took off to Vermont, of all places. That's kind of interesting, right? Just the opposite climate and country of Phoenix, but that's what they did. All right, so hey, more power to you, Core Power. All right, but in any event, they believe that this land right here is worth about $70 million by itself, just the dirt, and they're looking for a new suitor to come and develop that space, which they think they'll have no problem getting here shortly. All right, Phoenix developer sets plans for Scottsdale industrial project. This is, I think, well needed. Guys, this is the Loop 101 right here. This is prime real estate, this site right there, guys. And so you're looking at some industrial warehousing coming to this area with this proposed creation equity site right there in this area. And by the way, going back to the map is so helpful, guys. I know the map's good for me. I'm a visual person. But here's Scottsdale. There's Loop 101. It's right in this area under the loop right there, which is literally prime. I mean prime real estate for anything, residential or commercial or industrial, you name it. Okay. So that's that right there. And that's coming. That's going to be well needed. Guys, there's a lot of people who would love to have some industrial warehousing right there, buildings and shells. And so that looks to be coming down the pike here shortly in 2025. All right. Now, let's just pivot really quick. Guys, the Cactus League spring training is here. It is here. It is this beautiful time of year. It's 70 to 80 degrees every single day almost. And the Major League Baseball teams are coming into town, and they are starting here later this month in February, okay? And so obviously people have already reported, and they're getting ready to rock and roll. Guys, if you have a chance to come out to Phoenix and go to a spring training game, you should. It is just amazing. It's just very relaxful. Weather's great, and you can see some good baseball before they get real serious about their season starting at the end of March, okay? So this is an article about Japan and other Japanese media and people coming from Japan to watch Shohei Ohtani, who is one of the best players in all of baseball in the world. And they play right here at Camelback Ranch, right there. It's pinpointed in the Glendale area. That's where the Dodgers are at. And that's where a lot of Japanese media and Japanese fans will be who love baseball to come watch Shohei Ohtani play spring training throughout the month of March. And there's the complex right there, which, guys, is really great location. Here's the 101, and here's the Mattel Adventure Park, and right here is where the Arizona Cardinals football play, right? So you have this huge shopping area, you have a casino, entertainment district of Westgate. And then right here, catty corner to an extent, is the Camelback Ranch Glendale baseball spring training facility. That's a mouthful. All right, guys. So that's all it's going to be today. It's kind of a quiet day, but I wanted to come to you here today live and not miss a beat and still deliver some impact and some good information for you today to take with you in terms of what's happening around the Phoenix area. To sum it all up, Phoenix is still a phenomenal place for investment and population growth in the future and for job creations and high paying jobs. And therefore, they're going to need housing. And with home builders getting a little bit skeptic in terms of what's happening with tariffs and labor supply being not as plentiful as it used to be, some of those home builders are putting this all on pause. Well, for Phoenix, that could be a mistake, okay? Because I know it's going to continue to keep growing, and if they can keep building, that's what we need, because we're about 11,000 homes short every single year, and we have to keep building at least that many every single year through the year of 2030 to get back into balance. Which, if they're going to pull back a little bit because they're not sure what's going to happen, I respect them, because they're businesses. They have to do what's best for their business. But man, all the signs are there that if they can keep moving forward with building properties somehow, some way, they're probably going to be able to turn the profit. Because even though it's going to be more of a balanced market moving forward, everyone's still predicting, because of lack of supply demand overall, generally speaking, you're going to have appreciation at the end of 2025 in the positive realm. Okay, so guys, thank you so much for joining us. Keep watching. And if you don't mind, like us and subscribe to our YouTube channel, Everything Phoenix, or give me a call, 480-660-5974. Until next week, guys, keep it classy, Phoenix. We'll talk to you soon.